If you're over the age of 65, your financial world is changing right now. Not next year, not after the next election, right now. Most retirees believe major changes to taxes and healthcare happen at the beginning of the year. January arrives. New rules take effect. You file your taxes in April, and then life moves on. But that's not what's happening this time. Because in the middle of 2026, a major piece of legislation is quietly activating some of its most important provisions. A law signed on July 4th, 2025. A law with a name you've probably heard before. The One Big Beautiful Bill Act, or as many financial professionals now call it, the OBBBA. You may have seen headlines about student loans. You may have heard debates about Medicaid. You may have watched politicians argue about who wins and who loses. But if you're a retiree, much of that noise doesn't matter. Because hidden inside this legislation are a series of changes designed specifically for seniors. Changes that affect your taxes, your Medicare coverage, your healthcare costs, and even the money you leave behind for your family. Some of these changes could save you thousands of dollars. Others could cost you thousands, if you don't know they're coming. And the most important part, many of these changes are happening right now, this summer. Today, we're going to break down exactly what this law means for retirees. We'll cover the new senior tax deductions, the Medicare changes already beginning to take effect, the disappearing tax credits, and the deadlines you absolutely cannot afford to miss. Take your time, grab a pen, and let's go through this, one step at a time. Let's begin with the change that could have the biggest impact on your wallet. Taxes. For years, the standard deduction followed a predictable pattern. Every year it increased slightly, a little adjustment for inflation, nothing dramatic, nothing life-changing. But under the OBBBA, that has changed. The standard deduction has been permanently increased. For individual filers, it now stands at $15,000. For married couples filing jointly, it jumps to $30,000. That's already a significant increase. But here's where things get interesting. Because lawmakers added something specifically for seniors, a bonus deduction, an additional $6,000 for qualifying individuals, and an additional $12,000 for qualifying married couples. Let's put that into perspective. If both spouses qualify, a married couple could receive a total standard deduction of $42,000. $42,000. Income below that threshold may effectively escape federal income taxation altogether. Think about what that means. Social Security benefits, pension income, IRA withdrawals. For many retirees, a substantial portion of their retirement income could now fall beneath that tax threshold. It's one of the largest retirement-focused tax changes in years. But there is a catch. You don't automatically benefit from a tax deduction that isn't properly claimed, which means your tax software, your accountant, or whoever prepares your return must be using the updated rules. Not last year's tables, not outdated assumptions, the new rules. Because if those deductions aren't applied correctly, you could end up paying taxes you never actually owed. And that's money you may never get back. But taxes are only one part of the story, because the next changes affect something retirees often worry about even more than taxes: healthcare. And what happens next could reshape how many seniors pay for medical care. Now let's talk about the issue that concerns most retirees more than anything else: healthcare. Not the stock market, not taxes, not politics, healthcare. Because no matter how carefully you've planned for retirement, unexpected medical costs can change everything. And that's why the next set of changes may be some of the most important in the entire law. The OBBBA is introducing two major healthcare shifts. One affects prescription drugs. The other affects how you access your doctor. Let's start with prescription medications. For years, certain expensive drugs sat in a category of their own. Many of these medications were designed to treat rare diseases, conditions affecting relatively small groups of patients. They're often referred to as orphan drugs. And because of special protections in federal law, many of these drugs remained outside Medicare's negotiating power. In simple terms, drug manufacturers could often set extremely high prices. And those costs eventually found their way back to patients, through premiums, through copays, through the healthcare system itself. But that system is beginning to change. Under the OBBBA, Medicare's negotiating authority is expanding. More medications are being brought into the process, including drugs that were previously untouched. For retirees relying on expensive specialty treatments, this could be significant. Because lower negotiated prices can eventually translate into lower out-of-pocket expenses, lower costs at the pharmacy counter, lower pressure on monthly budgets, and fewer difficult decisions between healthcare and everything else. If you or your spouse rely on high-cost medications, now is the time to review your Medicare Part D coverage. Not next year, not during open enrollment, now. Because the pricing landscape is changing, and understanding those changes early could save you money. But that's only half the story. Because another healthcare shift is happening quietly, one that could fundamentally change how some retirees interact with their doctors. Have you ever felt rushed through a medical appointment? You wait weeks for a visit, sit in a waiting room, finally see your doctor, and before you know it, the appointment is over. You're left with more questions than answers. That's one reason direct primary care has become increasingly popular. Under this model, patients pay a fixed monthly fee directly to their physician. No complicated billing, no endless paperwork, no insurance middlemen controlling every interaction. Instead, patients often receive longer appointments, more direct access, and a stronger relationship with their doctor. For years, however, there was a major obstacle. Many people couldn't easily use health savings account funds to cover those recurring membership fees. The tax rules simply weren't designed for it. But under the OBBBA, that barrier is beginning to disappear. Eligible direct primary care expenses can now be treated differently under the tax code, which means retirees with HSA balances may have greater flexibility in how they pay for care. Think about what that means. Money you've already set aside for healthcare can potentially be used more effectively. To gain access to a doctor who actually knows your history, a doctor who has time to listen, a doctor focused on prevention instead of rushing from patient to patient. For retirees managing diabetes, heart disease, arthritis, or multiple chronic conditions, that kind of access can be incredibly valuable. And that's why many healthcare experts view this change as one of the most overlooked provisions in the law. Because while headlines focus on politics, retirees are gaining new options for managing their healthcare. But as with every major law, there's a trade-off. Some benefits are arriving, others are disappearing. And the next section covers a series of tax credits that are about to vanish forever. Miss the deadlines, and the opportunity may be gone for good. So far, we've talked about new opportunities, new deductions, new healthcare options, new ways retirees may be able to keep more of their money. But every major tax law has two sides. For every benefit that's created, something else usually disappears. And that's exactly what's happening now. Because while the OBBBA introduces new tax breaks for seniors, it's also eliminating several tax credits that millions of Americans have relied on for years. Some of those credits are already on borrowed time, and once they're gone, they're gone. No extensions, no exceptions, no second chances. Let's start with one of the most popular incentives in the tax code, energy tax credits. For years, homeowners have been encouraged to make energy-efficient improvements, installing solar panels, upgrading heating and cooling systems, improving insulation, replacing outdated equipment. And in return, the federal government offered generous tax credits to offset the cost. For many retirees, those credits made expensive home projects financially possible. But now, that chapter is coming to an end. Under the OBBBA, several major energy incentives are scheduled to disappear, which means homeowners planning future upgrades may be facing a rapidly closing window. Think about it this way. Imagine you've been considering solar panels for the past year. You've gathered estimates, you've talked with contractors, you've delayed the decision because life got busy. Now suddenly, the clock is working against you. Because a project completed after the deadline may no longer qualify for the same federal tax benefits. And depending on the size of the project, that could mean losing thousands of dollars. Thousands. Not because the project wasn't worthwhile, not because you didn't qualify, but because you waited too long. That's the danger of tax deadlines. Most people don't miss them because they're irresponsible. They miss them because they assume there's more time. And then one day, the opportunity is gone. That's why retirees considering major home improvements need to start asking questions now. Not 6 months from now, not next year, now. Talk to your contractor, review your timeline, understand which projects may be affected, and determine whether accelerating the work could preserve valuable tax benefits. Because once a credit expires, Congress rarely brings it back. And energy credits aren't the only deadlines retirees should be paying attention to. Many tax opportunities are governed by one simple rule: timing. The difference between saving thousands of dollars and saving nothing at all often comes down to a date on the calendar. That's why staying informed matters. Because retirement planning isn't just about investing. It's about understanding the rules before they change. And right now, those rules are changing quickly. But before we finish, there's one more part of this legislation retirees need to understand. Because it doesn't just affect your money. It affects the money you leave behind, your children, your grandchildren, and the financial legacy you'll pass to the next generation. And that may end up being one of the most important changes of all. For many retirees, retirement isn't just about spending money. It's about giving it meaning. After decades of working, saving, and building a life, many people begin focusing on something larger than themselves. Their church, their community, their favorite charities, their children, their grandchildren. And that's why the next set of changes could be especially important. Because the OBBBA doesn't just change how you earn and save money, it changes how you give it away. Let's start with charitable giving. For years, many taxpayers faced a simple problem. If they claimed the standard deduction, they often received no tax benefit for charitable donations. In other words, you could donate generously and still receive no deduction at all. That frustrated a lot of people, especially retirees who regularly support their church, local organizations, and community causes. Under the new rules, that begins to change. Even taxpayers who take the standard deduction may now qualify for a separate charitable deduction, which means charitable giving could become more rewarding for millions of retirees. It's a subtle change, but an important one, because it recognizes something many retirees already understand. Giving isn't just for wealthy people, it's for everyone. But there is another side to this story, because not every taxpayer will benefit equally. Higher income retirees who itemize deductions may face a more complicated calculation, which means charitable planning may become more important than ever. Instead of making donations casually, some retirees may need to think strategically. When to give, how much to give, and which assets to donate. Because even small changes in tax law can affect how efficiently wealth is transferred. And speaking of transferring wealth, that brings us to one of the most talked about provisions in the entire bill, the so-called Trump accounts. You've probably heard the name, but most Americans still don't know what these accounts actually are. Here's the simple version. The government is introducing a new category of tax-advantaged savings accounts designed specifically for children. The goal is straightforward: encourage long-term investing, encourage financial education, and help families build wealth across generations. Instead of focusing solely on retirement, these accounts focus on beginnings, the beginning of adulthood, the beginning of financial independence, the beginning of a child's future. Think about your own life. How different would things have been if someone had started investing for you when you were young? 10 years, 20 years, 30 years of compound growth. That's the idea behind these accounts. To give children a head start that previous generations never had. And for many retirees, that opportunity may be incredibly appealing. Because one of the greatest joys of retirement is watching future generations succeed. Watching children buy homes, watching grandchildren graduate, watching families become financially secure. These new accounts are designed to support exactly that. And if the rollout proceeds as planned, many financial advisors expect significant interest from grandparents. Not because of politics, not because of headlines, but because the concept itself is powerful. A structured way to invest in the future of the people you love. And for many retirees, that may end up being one of the most meaningful opportunities created by the entire law. But before you start making plans, there's one final question we need to answer. What should retirees actually do right now? Because information is valuable, but action is what ultimately matters. Retirement is supposed to be the reward for decades of hard work, decades of saving, decades of sacrifice. But retirement doesn't exist in a vacuum. The laws change, the tax code changes, the healthcare system changes, and sometimes those changes happen faster than anyone expects. That's exactly what's happening right now. The One Big Beautiful Bill Act isn't a proposal, it isn't a campaign promise, and it isn't something Congress might pass someday. It's already law. And its provisions are beginning to affect millions of retirees across the country. Some of those changes could put more money in your pocket, others could save you money on healthcare, and some could help you create opportunities for your children and grandchildren that simply didn't exist before. But none of those benefits matter if you don't know they're there. Because the biggest financial mistakes are rarely caused by bad decisions. They're usually caused by missing information. By learning about a tax break after the deadline. by discovering a healthcare option after you've already overpaid, by finding out about a financial opportunity after the window is closed. And that's why staying informed matters. Not because every law will change your life, but because sometimes one law can. So let's review the key takeaways. First, make sure you're taking advantage of the new senior tax deductions available under the law. If you're working with a tax preparer, ask questions. Don't assume everything is being handled automatically. Second, review your healthcare options. Take another look at your Medicare coverage. Understand how prescription drug changes could affect you, and explore whether newer healthcare models may fit your needs. Third, pay attention to deadlines. Tax credits don't last forever, opportunities don't stay open forever, and waiting until the last minute rarely works in your favor. Finally, start thinking beyond yourself. Think about your children, think about your grandchildren, think about the legacy you're building. Because wealth isn't just about money, it's about options, it's about security, it's about creating opportunities for the people you love. And sometimes, the most important financial decisions you'll ever make aren't the ones that benefit you. They're the ones that benefit the next generation. A lot of retirees spend years worrying about whether they've saved enough, whether they've invested enough, whether they've planned enough. But the truth is, financial confidence doesn't come from knowing everything. It comes from staying informed, adapting when circumstances change, and making thoughtful decisions one step at a time. Because no matter what Congress does, no matter what the markets do, and no matter what new laws emerge in the years ahead, knowledge remains your most valuable asset. And today, you have more of it than you did yesterday. If you found this information useful, share it with someone who might benefit. A friend, a sibling, a fellow retiree, a parent, a neighbor. Because the people who need this information most are often the least likely to hear about it. And one conversation, one shared video, or one piece of advice could save someone thousands of dollars. The rules may have changed, but you're not powerless. Stay informed, stay prepared, and most importantly, protect the retirement you've spent a lifetime building. And we'll see you in the next one.